webcast is now starting. All attendees are in listen-only mode.
Welcome to TaxLink's latest webinar. Our webinar for the month of February is on, actually March. Our webinar for the month of March is on the U.S. transition tax. We have a great panel here who's going to talk to you about this new law that came into effect with the latest tax reform in the United States. Just to get some admin issues out of the way, this webinar is being recorded. We're going to have an audio recording of the webinar available for you shortly after we're done. We'll also have a full transcript that's going to take us a little longer to get done, so we will share that with all of our network. Besides that, if you have any questions and want to ask our panelists, make sure to use the GoToWebinar control panel. The GoToWebinar control panel is You'll be able to send questions there, and I will try to incorporate them as moderator into the discussion. So without further ado, I'm going to ask our panelists to introduce themselves, and then we'll get started with the 8 or 9 questions that we have collected from our members and have a good discussion on the U.S. transition tax. Karen, would you like to introduce yourself first?
Okay. My name's Karen Alpert. I'm a lecturer in finance at the University of Queensland, and I do research in the basically in taxation and how it affects individuals, as well as how it affects financial decision making.
Excellent. Thank you, Karen. John, brief introduction.
Sure. My name is John Richardson. I am a lawyer, a Toronto, Canada-based lawyer, and essentially what I do is run a specialty service for U.S. citizens and green card holders who are impacted by the effect of U.S. extraterritorial laws. So that includes expatriation and a variety of things, and any ways that U.S. laws extending outside the United States affect them.
Excellent. Thank you, John. Okay, so let's get started with our questions. Just to get us started, let's just have a very general question on who does a transition tax affect. I know we have some more detailed questions later on in terms of who it does affect, but just generally speaking, who does the transition tax affect? Karen, you want to get us started with that one?
Yeah, well, so if you take a literal reading of what they've actually written in the law, it applies to U.S. shareholders, which is a defined term in the Internal Revenue Code, and that basically consists of any U.S. person that owns 10% or more of a foreign corporation. And so it's a U.S. shareholder that owns a specified foreign corporation, which would basically be any controlled foreign corporation or any corporation with a U.S. domestic corporation that owns 10%. So it's really broad, but basically if you're a U.S. person and you own 10% or more of a foreign corporation, you need to look and see whether this applies to you. Now that's literal. Whether Congress intended to catch up small individuals that live overseas is another question that John might have some insight on.
John, anything to add to Karen's explanation, or?
Well, of course, an excellent answer and explanation from Karen. I would reinforce, though, that the practical impact of this for we're talking about people. If you want to talk about people outside the United States, would be if they have what are called controlled foreign corporations. And a controlled foreign corporation would be where you would have a United States shareholder who owns 10% or more of a corporation that's collectively owned by 50% or more of United States shareholders. And so what does all that gobbledygook mean? What it means from a practical point of view, although I do not believe for a minute that this was intended, it's being interpreted by the tax compliance community to mean that if you have a small business corporation, say a dentist or a doctor or a shoe store outside the United States, it's an incorporated business. It's not a business that's eligible to take the check the box election, and you have 10% or more of it, then you're caught up in this. It's a extremely serious, and I would argue egregious overreach of a U.S. tax jurisdiction.
Okay, excellent. Since we're talking about because international, U.S. Residents abroad, etc. I'll jump to the question about U.S. shareholders of CFCs. So to actually delve into this a little bit more, and these are questions I know Karen submitted. So what impact could this tax have if applied to non-resident individuals who are U.S. shareholders of CFCs? More specifically, what is the impact on the individual, and what is the impact on the tax base of the country where the CFC is incorporated, the local economy? You want to get us started there, Karen?
Yeah, well, I'll look at the local economy because basically what's happening is the IRS is coming into these local corporations that are owned by local residents, often citizens of the countries where they're living, and the IRS is coming in and saying we're going to tax your retained earnings before your local country has a chance to apply tax to that. And there are ways you can get foreign tax credits to offset the U.S. tax, but given how the short time frame between when the law was enacted on December 22nd and the end of the tax year that it applied to, December 31st, there's going to be a lot of people who haven't had the time to create foreign tax where they live, if that's what they wanted to do, to offset the U.S. tax. So there's going to be some double taxation happening here, and it's going to be the U.S. coming in and grabbing money out of the local economy. And not only is the local economy losing the tax the U.S. is collecting, but also the fees they have to pay somebody for this very unproductive job of figuring out how much tax to pay the U.S. So all of this money is going out of the local economy and will not be available for the individuals to earn, yes, no longer their capital's been reduced, right? But the capital or their ability to invest in the local economy has been reduced. And their eligibility for means-tested social safety net, they're going to be more eligible, like in Australia, for the age pension and things like that, because they're not going to have as much wealth.
Excellent, thank you, Karen. John, anything to add to that on this question? I know you mentioned that you discussed this earlier a bit.
Well, Karen's answer focused, in economics, of course, we have macroeconomics and microeconomics, and Karen's answer was an excellent answer on the macroeconomic level of what would happen as essentially the money supply in a country is being reduced. Monetary policy, for example, is the expansion of economy through injecting money into it. And you can go the opposite way by taking money out of it. And what Karen is really describing is a situation where the United States, by taking a preemptive tax strike on the capital base of another country, is reducing capital and therefore hurting the economy. But focusing on the individual, there's something about the world of tax where there's a disconnect between what it says and what it actually means. For a lot of these small business corporations, particularly in Canada, maybe less so in Australia, depending on basically how the retirement planning or social security system of different countries work, the retained earnings, the undistributed earnings in these corporations actually function as people's private pension plans. So for an individual in Canada or a similar country, to be subjected to this particular regime actually results in either the outright confiscation or the severe erosion of their private pension plans. Severe erosion, Karen referred to the possibility of, say, paying a dividend or some other kind of distribution to generate a foreign tax credit to be used against the transition tax. That's an early payout. All right, at best, okay, and once there's an early payout, you're eroding capital that can be used for future growth, or in many cases, because it's double taxation, obviously, that's nothing but a confiscation of a share of the retirement plan or other form of wealth. And I think it's extremely, extremely important to recognize and understand on this, that this is an example. Of course, we're dealing with the U.S. tax rules which is a policy of taxing the residents of other countries. Now, let's compare how the transition tax might affect a resident of the United States with how the transition tax might affect, say, a resident of Canada. And interestingly, it is not a bad thing for the resident of the United States who is not also a tax resident of Canada, because the way the transition works is an early payment of some tax at a greatly reduced rate, and that amount of income will never be subject to U.S. tax again. So from the perspective of a U.S. resident, I don't know that it's desirable because it does require a payment. But in the long run, it's not a bad deal, and it's probably a good deal. Why? Because they're not subject to the double taxation that residents of other countries are. We compare that to how that tax would impact a resident of Canada, and at the very best, you've got significant erosion of the wealth or retirement asset, and more likely, you've got pure double taxation. So what's good for a resident of the United States is an absolute disaster for somebody who's not a resident of the United States and is therefore a tax resident of another country. Basically, the bottom line, and there's really no other way to put this, the way the transition tax would affect residents of other countries is it's a wealth confiscation.
Yeah, when you look at a resident of another country who's going to be paying tax in that country, if it's a high tax country, under the old rules, they probably never would have paid any U.S. tax on that income, because they would have generated U.S. tax and their local foreign to the U.S. tax at the same time, and their local tax would have exceeded the U.S. tax, and so they would have paid only their local tax. They would have gotten a foreign tax credit that would have completely offset the U.S. tax. But by changing the timing of the U.S. tax and front-running it with this transition tax, the U.S. is now collecting tax when they never would have collected tax from these corporations.
I would also add to that, if I may, that let's not lose sight of the fact that what this transition tax is doing is imposing taxation on income that was never, ever, ever subject to U.S. tax before. What it's specifically doing is going in and deeming the income of a corporation that, because it didn't qualify as subpart F income, was never taxable up until this moment. So not only are they coming in and taking a preemptive tax strike against a capital base that, under international tax rules would belong to another country, but they are doing this retroactively in the sense that the capital that is subject to the tax at the time that it was earned and accumulated was never subject to U.S. taxation at all. So therefore, you've got the preemptive tax strike on income that they are redefining as subject to U.S. tax. So I mean, it's really quite extraordinary.
Okay, excellent. Thank you for that explanation. We talked a little bit about cases of double taxation, so I'm going to combine that question with another one and take a look a little bit at that more in greater depth. So will the imposition of this mandatory transition tax lead to any cases of double taxation? And the second question, I guess, as part of this question is, are there any ways to use existing tax treaties to argue that the transition tax should not apply? Karen?
Yeah, definitely there's going to be double taxation in some instances. And so the double taxation is going to happen when you don't align the timing of the tax paid in the two jurisdictions, the U.S. and the foreign jurisdiction. If they're aligned in the same year, or if the U.S. tax is later, then your foreign tax credits are going to offset the U.S. tax. But the U.S. only allows foreign tax credits to be carried back 1 year. So that gives you 2018 to generate some foreign tax credit that might be able to go back and offset your transition tax from 2017. If you wait any longer than that to distribute the money and generate foreign tax, then you're never going to be able to go back and offset that U.S. tax. Plus, and like John said, if you're distributing now, which is before you wanted to distribute, you're reducing your capital and your capacity to earn in the future. So that may not be optimal. So in order to avoid double taxation, you need to be able to offset that U.S. tax with the foreign tax. Individuals can do that somewhat with the Section 962 election, which we can talk about later if you like. But that will help avoid some of the double taxation, or generating a dividend that gives you foreign tax credit could possibly do that as well.
John, anything to add?
Well, your question covered a wide range of topics. Karen was addressing the issue of the extent to which tax paid, and I'll use the example of Canada, could be used to offset this transition tax. And the answer to that is yes. Okay, but it's technical. It's not necessarily that easy to do. I think it might be helpful to recognize that there's two ways. What you're doing is you're offsetting the U.S. tax by Canadian tax paid. To the extent that a dividend without a timing mismatch would be paid to a shareholder, the individual who is taxable on the dividend in, say, Canada, could perhaps use the tax paid in Canada against the transition tax, which the transition tax, as you know, is a tax levied on the level of the U.S. shareholder. The 962 election to which Karen refers is actually using the tax paid by the corporation to offset the transition tax. I mean, if you think about this whole thing, I mean, it's really, quite ridiculous, right? Because, so the transition tax is subpart F inclusion. The subpart F inclusion, and this needs to be understood, is where the Internal Revenue Code says, well, so you're the U.S. shareholder of a controlled foreign corporation. And we don't like the fact that, you've got this corporation out there that's earning money. And, we don't like the fact that, that has potential to defer tax. So what we're going to do is, we're going to say that this income earned by the corporation is actually, we're going to attribute it to you personally. I mean, you use a foreign corporation, you're going to pay the tax. Okay, we're going to attribute this income to you. But I mean, I think a reasonable response to that, I mean, a 5-year-old in a sandbox might say, well, what? Come on now, the corporation itself has been paying tax on this income. So the 962 election is a way to use, for the individual to use the actual tax paid by the corporation. So those would be the general ways of making use of tax paid in, say, Canada to offset that. Again, 962 election at the level of the corporation, and the dividend or some other distribution taxable to the individual shareholder at the level of the individual. Of course, if those things don't align properly, you're going to have problems. Now, you'd also asked in your question about the issue of tax treaties. And this is interesting. In the same way that the transition tax, which is a subpart F inclusion, has gotten a lot of tax practitioners thinking, possibly for the first time in a serious way, about subpart F inclusions, which really are, in fact, is the U.S. imposing taxation on the undistributed earnings of corporations. But I think it also should get people thinking about what the tax treaties might say about this. For example, I believe it's Article 10, Section 5, I think, of the Canada-U.S. Tax Treaty, specifically would prohibit the United States from imposing taxation on the retained earnings, the undistributed earnings of a Canadian corporation. But yet, Section 965, in its absolute plain terms, makes it clear that what you have to do is you have to look to the undistributed earnings and attribute them to the shareholder. And it would seem to me that, I mean, I understand all this stuff about, well, a tax imposed on the individual, not the corporation, but what the treaty says is that the United States is not able to impose tax on the undistributed earnings. And I think that ought to be considered as a defense to this, because they're not able to impose tax according to the treaty on the undistributed earnings. The subpart F inclusion doesn't change the fact that they're imposing tax on the retained earnings. It's simply the mechanism that they appear to be using to do something that the treaty may well prohibit them from doing.
To what John has said, or jump to the next question?
Yeah, well, so I think that there's another possible treaty defense, which is the double taxation one, because the double taxation article in all the treaties says that there won't be double taxation, and that the competent authority should agree as to how to deal with to avoid double taxation. So that might be a possible defense as well.
I would point out also that as far as I am aware, you know, anytime you're talking about U.S. tax treaties with respect to individuals, you have to watch out for this thing called the savings clause. And the savings clause in the U.S. tax treaty basically says, you know what, no individual U.S. citizen can presumptively have the benefits of any tax treaty. And by agreeing to this, and by, in other words, you know, we can impose U.S. tax according to the Internal Revenue Code on U.S. citizens. But interestingly, by signing a treaty with a savings clause, I mean, it's clear these things were, you know, were conceived before global mobility. Let's say you look at Canada or Australia, where you have all kinds of people who may be American citizens, but they're also Canadian or Australian citizens. A country that signs and agrees to the savings clause is actually agreeing to allow the United States to come in and impose U.S. taxation according to the Internal Revenue Code on their citizens who are residents, who just happen to be U.S. citizens. It's, I mean, if you think about it, it's absolutely outrageous. My point, though, is that, you know, if we talk about the treaty prohibition or presumption against double taxation, that is, generally speaking, an exception to the savings clause. So if one can argue that that were to apply, one would not, as far as I can see, have to worry about the savings clause argument.
Yeah, on the other hand, the argument about undistributed corporate earnings, the U.S. is going to argue that the tax is imposed on the U.S. citizen, and therefore the savings clause means that the U.S. citizen can't take benefit of that clause. The U.S. is going to argue that. Whether the other side of the treaty, the other party to the treaty agrees, is another issue.
Well, I think, you know, Karen raised an extraordinarily important point here, that, you know, the next sort of level of the discussion, if one were analyzing this, would be, well, okay, so we've got a treaty section that in its plain terms, right? I mean, the people who argue the transition tax applies to Americans abroad say in its plain terms, the transition tax applies to individuals outside the United States. So why don't we read the treaty in its plain terms? And in its plain terms, the treaty would appear to prohibit the United States from doing that. The mechanism of attributing the income to the individual so they can make the argument they're taxing the individual and not the corporation is really, that has to do with the methodology that they're using to impose taxation on undistributed or retained earnings, which the treaty says they can't do. That would be my first point. The second one is that, and this is just so important, is that tax practitioners have a tendency when they look at the treaty, they look up, you know, see what the IRS says about the treaty. Well, you know, that's important. That's relevant. But the simple fact of the matter, you know, with what the law is that both countries are able to interpret the tax treaty. And I find it absolutely extraordinary and almost unfathomable that a country like Canada or Australia would sign a treaty where they understood that the United States could come in and essentially raid the unretained, the undistributed earnings of Canadian-controlled private corporations. I mean, I think it's an important. I think it's an issue. I would encourage tax practitioners to consider it and not just blow this off. The United States is not the sole arbiter of what these treaties mean.
Yeah, I agree.
Okay. Switching gears a little bit, let's get to, I guess, technical aspect of this, as in how is the transition tax calculated? And we had a question from one of our members, who he asked basically, can anyone demonstrate how the tax would be calculated after reviewing a balance sheet? Any thoughts on that? John, you want to get us started on that?
Well, let me answer the question in a general way, and then we'll turn it over to Karen for perhaps more specifics, okay? But so what it is, all right, must be understood, it's a subpart F inclusion. So it's an amount of money that was earned by the corporation, never been taxed by the United States, and the Internal Revenue Code says, well, we are going to deem that income to be earned by the individual, and it just then goes on the individual's tax return, okay? So that's the mechanism for how it works. Now, I mean, to put this in perspective, this goes back to 1986, okay? So it's not calculating income and taxes for every year since 1986. It's looking at the undistributed earnings, and we'll get to the balance sheet in a minute, okay? Which, generally speaking, the balance sheet would be a reasonable beginning on that. Now, not even something as outrageous as this could possibly want to impose sort of full taxation on everything back to 1986. So what then happens is, step one, I mean, let's imagine that we have a $10 million amount of retained earnings, or an amount that's subject, okay, to this taxation. Step one is you move that over to the income. It's just, put on the individual shareholder's tax return as ordinary income. The next thing is that the section does not treat all forms of income the same way. It makes a distinction between cash and liquid assets and fixed assets. The purpose being to impose higher, more punitive taxation on the part of the retained earnings that are essentially considered to be cash or liquid assets. And by the way, that's why also, I mean, this is incredibly discriminatory, because let's say you have a small business corporation, you invested in a building or land or something, you would be subject to this tax at a lower rate. But if you're really using it as a private pension plan, it's more likely that it wouldn't be invested in cash or cash equivalents. So the greater the extent to which the retained earnings are actually being used in the form of a private pension, the higher the level of taxation or confiscation. So after you go through the mechanism of deciding, how much is cash and how much is liquid, then what happens is it gets moved. Then what happens is there's a deduction, if you will, a recognition that, well, in its sense of justice, and that the United States will not impose the full amount, taxation on the full amount. So then what happens is that a certain amount is excluded, and the amount that is excluded is an amount that would be necessary to bring the effective tax rate for cash down to 15.5% for corporations, and I think about 8% for fixed assets for corporations. But remember that the income is going on an individual U.S. return, and in 2017, the corporate tax rate was 35%. The individual return was 39.6%. So effectively what happens is, and this is simply unbelievable, okay, that individuals, who, by the way, get none of the benefits of the so-called move to territorial taxation, are actually required to pay tax on this at a top rate of 39.6 instead of the 35% for corporations. So they get less, they're treated more harshly. I mean, in a nutshell, that is the way that the process is followed through. Then once the amount of the tax is calculated, I would add that it's a tax that's owing in 2017. But because it's so punitive and so horrendous and so frankly unprecedented, and it's really retroactive, once the tax is calculated, you have an 8-year payout. Okay, you can pay it out over 8 years. And it's for the first 5 years is 8%, year 6 is 15%, year 7 is 20%, year 8 is 25%. In order to do that, you're required to make the first payment by what the legislation says is April 15th. Recognition that's pretty much impossible. Yesterday, the IRS came down with a bulletin indicating that for individuals, well, it's complicated, so I urge anybody listening to this to read it. But what it appears to do is for Americans abroad to allow them to make the first payment June 15th, along with when their tax return is due. And I will pass this over to Karen to fill in some more of the technicalities.
Yeah. Okay. So if we want to go back to our balance sheet, really, you need two numbers to calculate the tax correctly, right? You need to know the post-1986 earnings and profits reduced by amounts previously taxed in the U.S. It's not on any balance sheet I've ever seen, but you can roughly, I mean, if you've got a company that was started after 1986, okay, because we're only going back to 1986, and that has no previously taxed income, then you can roughly approximate that number with your retained earnings, but you have to calculate it all using GAAP, using the U.S. generally accepted accounting principles. So we're talking about foreign corporations here. They're not using GAAP, right? So you got to restate your balance sheet using GAAP and figure out what the retained earnings would be. And you have to do it on a using your tax accounting methods. So you're going to have to account for some timing differences like tax depreciation and some permanent differences as well, but not all permanent differences. So it's a really complex computation to figure out your earnings and profits. So you're going to do that. That's not really on your balance sheet, but you can approximate it. And then you also need to know the market value of your cash and cash equivalents. And that's market value, not book value. So that's not on your balance sheet either. So you've got two numbers you need, but neither one of them are really on your balance sheet, right? Okay, so your earnings and profits, if you've been filing Form 5471 since inception, you've been reporting a current earnings and profits every year. And all you have to do is add them up and you've got that and adjust it for dividends and any previously taxed income. But if you haven't been keeping track of that, this is going to be a big job. There's a couple other, the whole earnings and profits things is really quite complex, and you're going to need probably some fairly expensive accountants to figure it all out. Anyways.
In many cases, it's simply not going to be possible without redoing the books. And who has records back to 1986? This reality makes it very, very clear that although Congress may have known that this thing applied to individuals, obviously nobody ever thought through how this would apply to individuals, much less to the issue of individuals, we'll use the phrase Americans abroad. The very fact that this has to be done according to U.S. accounting rules would make compliance impossible. Without actually taking all those books and records, really to the inception of the corporation and getting them redone completely, which cannot be done because nobody keeps books and records back to that point. And even if it could be done, you could be looking at hundreds of thousands of dollars of accounting fees. People who are going to comply with this, the best I think they're going to be able to do as well, a best efforts type of thing. I would also point out that it's not, like we're talking here, one might get the impression that, everybody understands how this works, in the legal and accounting profession. And the fact is that very, very few people have really had the time and energy to understand this. And those who have still have many questions with respect to how it works. It's an unbelievable disaster. And I think that I think that with this provision, it's bad enough applying to individuals, but to apply to Americans abroad is now to create a section of the Internal Revenue Code where compliance really isn't possible. So I don't know what people are going to do, but I think that this may be a seminal moment in people's acceptance of what the United States might call citizenship taxation, but in all practical terms is really imposing worldwide taxation on tax residents of other countries who don't live in the United States. It's outrageous.
Okay, I guess as a follow-up to this in terms of let's look at how will transition tax affect renunciations of U.S. citizenship. I think this might the numbers are growing in terms of the number of people who are giving up their U.S. passports, etc. So how will this transition tax affect that? John, you want to get us started with that one?
Well, I think there's two levels of answers. The first is that a lot of people have hung on to U.S. citizenship in the hopes these rules will change, or they keep saying this isn't that bad. But now what has happened is that the United States has imposed retroactive taxation, okay, on a pool of capital that was never subject to U.S. tax. That's the first thing. The second thing is normally taxation is imposed when there's some kind of a realization event, meaning you actually sell something to free up money to pay the tax. There's no realization event whatsoever here. No realization event. This is simply saying, whoa, we see you've got some assets there. We're just going to take some of it. Thirdly, Karen's gone over how this is really a preemptive tax strike against the tax base of other countries. But I would think that the fact of the non-realization event and the retroactivity causing the double taxation and the virtual confiscation of retirement assets will make it impossible for Americans abroad to ever trust the United States. And I mean, if you can't live as a United States citizen outside the United States, then you're going to renounce. So I predict that it's going to provide huge incentives to renounce U.S. citizenship. The second part of the answer, though, is on a technical level, and this is extremely important for people to understand. That there's good news and there's bad news. The transition tax actually could make renunciation less expensive for what are called covered expatriates. And without going into all the definitions of covered expatriate, if you're not a dual citizen from birth and if you have assets of over $2 million US, you would be subject to the U.S. exit taxes, which are complex, but they would include a deemed capital gain tax on various assets, including the shares of controlled foreign corporations. Now, one of the interesting aspects of the Subpart F rules and the transition tax is that once the transition tax has been paid, that amount would never be subject to U.S. taxation again. So what that means is that on an expatriation, and this, if it comes in even at 17.54%, it would be less than perhaps you'd pay on a deemed capital gains tax. So it may actually make an exit tax less expensive for somebody than it would have been. And that's not a bad thing for people who've made the decision that they want to get out of U.S. citizenship. A second interesting feature of the transition tax, I talked about the 2 million net worth test, which may sound like a lot of money if you're living in rural Kentucky, and where, by the way, I have family, so that's not a suggestion that people there are poor or anything. I have family there. $2 million probably sounds like a lot of money where you can buy a house for $100,000. But I mean, if you live in Toronto or London or Vancouver or even major East Coast cities, you're going to have more than $2 million. But the transition tax is a liability, and it could be so high that it could actually reduce somebody's net worth below the $2 million and mean that they would not be a covered expatriate.
Karen, anything to add in terms of renunciations? What's your take on that?
Yeah, well, so for those who weren't planning on renouncing and really didn't think they could afford to pay the exit tax, and then there's all of a sudden faced with this transition tax. I think that their answer is going to be to hide, to say that's it, we can't comply anymore. We're gonna, possibly renounce without complying, or possibly just try and just stop complying with U.S. taxes, because it can be a really big hit for some people, and especially if you're in Canada and a Canadian citizen, where the U.S. can't collect the tax from you anyways. They can, send you bills all they want, but Canada will not help them collect against a tax that was incurred while they were a Canadian citizen. So I think you're going to see compliance rates drop, and people, they may or may not formally renounce, but they're going to stop complying and try to hide from being a U.S. citizen. I think there've been a lot of informal renunciations. People trying to get rid of their U.S. citizenship without formally renouncing, because they don't want to trigger an exit tax.
Or they may very well not start complying. One of the interesting features of this is that, if you look at this contextually, so pursuant to the FATCA inquisition, banks have been sending out letters, or, were a few years ago, all around the world trying to identify U.S. share owners of these small business corporations. A lot of people enter the U.S. tax system with small business corporations under, say, the streamlined program, where, these assets were fully disclosed, and it was agreed that the corporate income was not subject to U.S. taxation. Now, just a few years later, they're saying, oh, sorry, we lied. It is subject to U.S. taxation. I would think that those people who entered the streamlined program, who came into compliance, who had not been in compliance, will have a very, very strong sense of betrayal over this. And I think justifiably so. It is very, very likely, in my view, that fewer and fewer people will now enter the U.S. tax system. There's general agreement that, not because of any evil intent, but because people just don't understand these rules, that there are lots of what the U.S. might call Americans abroad, but I would prefer to call citizens and residents of other countries who just happen to have U.S. citizenship, who are not in compliance. And I think that this is very, very likely to end any incentives to come into compliance. One other point on how it affects renunciations, and this comes back to the 962 election. We had talked about using foreign tax credits, whether by the individual or the corporation, to offset the transition tax. And I think it's important when one considers renunciation that I made the point that if the tax was paid completely, then that's it. It's not going to be taxed again. But if one uses the 962 election, that's only a deferral, okay? That does not mean that if one were to renounce, that the retained earnings would be excluded from further taxation. So if we go back to, using various forms of tax credits, I think that the question of whether one would use the 962 election depends largely on whether they plan on renouncing, and if they were renouncing, whether they'd be a covered expatriate.
And if they're not renouncing, whether they're in a high tax country or a low tax country.
Well,
so
yeah,
if you're in a low tax country, you're not going to want to use a 962 election. If you're in a high tax country, then you can use a 962 election. The U.S. taxes your retained earnings again when you distribute it, but you've got enough foreign tax credit to offset that.
Right. Yeah. And then, of course, say in Canada, and I assume a lot of other countries, many countries have different rates of taxation, corporate rates of taxation, whether it's a small business corporation or a larger one. So it's extremely important that nobody, it's one thing to absorb general principles of this, but you have to see how the principles apply in your own situation.
Yeah, you got to run the numbers before you could do anything, because each company is going to look different.
Excellent. We have about 15 minutes left. I think we'll cover one more question and basically ask you guys for some concluding remarks. This one is kind of out of left field. This one is concerning cryptocurrencies. And the question is, will cryptocurrencies such as Bitcoin be considered cash equivalent in terms of transaction tax calculations? Any thoughts on that? Karen?
Yeah. So cryptocurrencies. The IRS has already ruled that a virtual currency is property, just like shares. So it's personal property. So then you got to look at what cash includes. Cash includes the fair market value of personal property, which is of a type that is actively traded and for which there is an established financial market. So if you're looking at Bitcoin, actively traded, there's a established financial market. I think there's no question that's included in cash for this. But if you've got some of the more esoteric virtual currencies that have very little liquidity or very little, value, market cap, not really market cap, but value traded, then I think you might be able to argue that there's not a established market. Or if you have a very large position, you might be able to argue that the current quoted price is not the fair market value for your entire position, because there would be a liquidity discount. If you started to try and sell, you'd move the market. So the fair market value of your position would be less than the quoted price if you had a large enough position.
John, anything to add on the Bitcoin issue, cryptocurrencies?
Well, I think that, Karen gave a fabulous answer there. I think that I would, I think that what I would say is that the issue really is whether the Bitcoin would be treated as cash or a fixed asset. In other words, clearly it can be part of the retained earnings, I think. If it's cash, it's going to come in at the higher rate, and a fixed asset, it comes out at the lower rate. Is that what you're saying, Karen?
Yeah, that's what I'm saying. I'm saying it's most likely to be part of the cash unless there's no established market for that particular currency. So Bitcoin is going to be treated as cash. So really what you're looking at is, you're not even looking really at what you have in fixed assets. You're looking at the cash, and we're going to say, okay, you've got retained earnings, or your inclusion amount, the untaxed earnings and profits. That's what we're going to tax, but we're going to tax a proportion of it at a higher rate, and we'll figure out what proportion based on how much cash you have, and anything that's left over, we're going to tax the lower rate. So, and because the cash is fair market value of the personal property, or of these traded securities, that cash, especially in the position that John was talking about, where you're using the corporation to save for your retirement, it's holding a portfolio of shares that are probably appreciated from when you bought them. So they're being held on the balance sheet at a pretty low number, and there's a low amount in your accumulated earnings and profits, but their fair market value is high. And so the fair market value of all of those marketable securities can easily be greater than your accumulated earnings and profits.
Right.
And in that case, the entire accumulated earnings and profits is taxed at the higher rate. And it doesn't matter how much fixed assets you have.
Yeah, I think that this is, for listeners, I think this is an extremely important point, okay, that, going back to the question, what can you tell by looking at the balance sheet? Well, I think you can come close to the amount, all right, of money that would be subject to the tax, but what it's not going to tell you is what the allocation is between the cash and the fixed assets. Of course, something like cryptocurrencies, we don't know the answer. So I would think that, I would think that a reasonably well-counseled person, given the decree by the IRS, as I understand it, that cryptocurrency is property, I suppose, would probably operate on a presumption that it's a fixed asset and only move it into the cash if there were the established market or something like that. But, you know, we're in uncharted terrain. There's no question about it.
Yeah, I think though for Bitcoin, you're pretty much stuck. Yeah, there's no question. Bitcoin's got an established market.
I think that's probably true with
Certainly.
Bitcoin, no question. But there are other cryptocurrencies.
Yeah.
Very good. So, as way of conclusion, I guess in a way of getting your concluding remarks, I'll use one of the questions that Karen submitted. Is the transition tax really that bad at the coalface? And how will clients ultimately handle this? John.
Could you repeat the question? Is it really that bad at the what?
Yeah. At the coalface.
Yeah. Where it's actually being implied. Yeah, go ahead.
And how will clients ultimately handle this transition tax? Just, you know, to wrap things up with this question. John?
The transition taxes, well, I think that the answer is it depends on the individual. Now, one of the things we haven't talked about is the fact that, you know, there are many Americans abroad who have, you know, healthy foreign tax credit carryovers and relatively small retained earnings in, you know, what are called foreign corporations. For them, I mean, you know, you run the exercise and then you say, well, this is the amount of U.S. tax, and then you know, look at what kind of foreign tax credits can be applied against them. And for them, it's going to be an expensive compliance or more expensive compliance exercise, but they'll probably escape. For the people, though, who have, you know, used their Canadian controlled private corporations, for example, as pension plans, which is very common in Canada, because, you know, these kinds of people don't have private pension plans, and who have, you know, retained earnings in the millions. I mean, it's far, far worse than it sounds when it's described by a tax compliance person who just sort of describes this as some, you know, new tax or something like that. It's a confiscation of assets is what it is. And what it means for practically for a lot of people that after this is said and done, you know, the retirement plans are over. That's it. You know, they're not going to have the capital base they need to retire. So that's what it does mean for a lot of people. And I think that that's frankly the message that needs to come out here, and not this sort of sanitized, well, it's just a tax or it's an early payout or something like that. How will people deal with it? The second part of your question. I don't know. I think that, I mean, in my experience in this world, you know, the results that the way that people deal with things is what their tax advisors tell them to do, because nobody can understand this. You know, their tax advisors say, well, you know, I'm going to help you figure this out, blah, blah, blah. I guess they'll pay it and be very, very angry people. I mean, I think that foreign governments, the government of Canada, Australia, really need to step in and protect their citizens. It's outrageous. In any case, it is I think, an irreparable breach of trust between the U.S. government and individuals living outside the United States.
Yeah, I think it's going to end up with increasing the level of non-compliance. So if you look at tax returns filed from overseas addresses, the compliance rate of Americans abroad is maybe 20%, and most of those are a good chunk of those are U.S. military and government employees who are stationed abroad. So the compliance rate's low already. It's certainly not going to increase because of this. Quite likely it'll decrease. Yeah, when the IRS notice came out today, one person commented on one blog that, well, yeah, why is this good news? It just means that I'm postponing when I jump off the bridge by 2 months. It's still going to be a problem in 2 months that, you know, and maybe just not in 2 weeks. So, if this is not fixed, and there is a movement to get it fixed, but if this is not fixed, I think there's going to be increases in renunciations and increases in people who decide that compliance is just not an option anymore.
On that note, I think it would be worth pointing out that you speak about the movement to get this fixed, and there are a number of people involved in that. But part of it is coming out of Israel. A lawyer by the name of Monty Silver, and he's definitely, and to his credit, out getting support to try to get this changed with respect to Americans abroad for no other reason, but they're subject to double taxation. And if somebody wants to send me an email or whatever, I'd be glad to get you in touch with him and help get your views known on this, and become a supporter of a movement that I think that he's certainly gotten going to get these things changed. I don't think they're saying the opera ain't over till the fat lady sings. This is so outrageous that I think that there is room to get this legislative damage changed. But if people sit back and don't make their views known, of course nothing will change. So there is an opportunity. I think it's time for people to speak their mind. The problem with this is that it's far worse than it sounds, because the people who are describing it are the people in the tax compliance industry who speak what I would call tax speak. They talk about the Internal Revenue Code, with 100% disconnect between what this legislation says and how it affects people's lives. So if you want to get information to join, I'll call it the Monty movement, send me an email and I'll put you in touch with them.
Excellent. I actually just got a couple comments from one of our listeners. She's a tax expert, and she's been paying attention, and she asked me to basically let you know just and see what your thoughts are on these. The first comment is regarding the calculation of the transition tax and the difficulty obtaining the numbers. Post 1986, E&P are currently tracked on Schedule J of IRS Form 5471, and therefore Schedule may be a helpful shortcut method to calculate the amount of income subject to the transition tax. That's when we're discussing.
That's assuming that it's
calculated.
That's assuming that it's been calculated correctly. And when you've got people who are just coming into compliance recently, they're not going to have done that necessarily correctly. So
I want to emphasize, I want to reinforce what Karen said. That is absolutely the truth, okay? Especially since a lot of these people have come into compliance, over the last few years with the streamline or something like that. The numbers on the 5471 for many of these people never could have been done correctly in the first instance. They don't mean anything.
Okay. And the second comment she had, she says, I appreciated John's discussion regarding the tax law section 965 conflict with the Canadian treaty that says the U.S. cannot tax the undistributed retained earnings of a corporation. Later in time rule, I believe this rule states that a U.S. tax treaty may be overridden by subsequent tax legislation.
Mm-hmm. Well,
that was her second comment.
Yeah, sure. I mean, yeah, that's what I would, that's what I would have expected. That is technically true, but if you go through the articles on this and really analyze the situation, it depends on what the intention that was expressed at the time. That's the first point. So in other words, the very fact of changing the legislation does not, in fact, override the treaty necessarily. Okay, there's a question of intention. But secondly, again, okay, we've got to recognize that the United States is not the only country that can interpret the treaty. A treaty is an agreement between two sovereign countries. I mean, the United States can take any position it wants, with respect to how its internal legislation impacts a tax treaty. But at the end of the day, both countries are going to be there to interpret that treaty. And, I'm going to go back to what I said. Given that Canada or Australia or any of these other countries has the right to interpret the treaty, I think it's a very reasonable question to ask. Did Canada and Australia understand that they were signing something that would allow the United States to come in and take, a frontal assault on the retained earnings of Canadian or Australian corporations that happen to be owned by Australian citizens and residents or Canadian citizens and residents. I appreciate the perspective. I appreciate the bringing up a point that there is the last in time rule, but that's the beginning of the inquiry and by no means the end.
Yeah, furthermore, I'd say that if the U.S. Continues to, or interprets every congressional new law as overriding treaties, eventually the rest of the world's going to realize that a U.S. treaty is not worth the paper that it's written on.
Oh, it's far worse than that, Karen, because what that means is that, I mean, it's, you know, I mean, to take that interpretation, I mean, just to show you where it goes, I mean, what it would mean would be that a country who signs a tax treaty with the United States is agreeing to certain things that the United States never has to agree to in any event. I mean, it's ridiculous.
Mm-hmm.
Right, exactly. Any final remarks? Or I think we've covered most of our bases. I think we covered all of the questions submitted by our members. So if there's anything else you'd like to add, you know, let us know. Otherwise, you know, I think that's a wrap. Anything, John, Karen?
No, I think we've covered it pretty well.
I would add
Excellent.
that I think the transition tax is a very, very bad thing if applied to Americans abroad, just in case people didn't get my message.
I think you've been heard loud and clear, John.
Good.
Excellent. So with that said, let me get some admin issues out of the way. This webinar has been recorded. We will be releasing the recording shortly. I'll share it with everyone who's been listening, to all the people who signed up for the webinar, and with all of our network. We will also have a transcript. That should take us a little longer, but once that's out, we'll also share it with everyone. If you have any follow-up questions for either John or Karen, please submit them on our forum. I'll make sure to pass them along to them and have them provide you with some answers. With that said, you know, thank you very much for this very engaging discussion, and hope everyone has a great day. Thank you, John and Karen, on behalf of TaxLink 2 for taking the time to do this.
Thank you.
Thank you.
Excellent. Goodbye.
Bye.